Credit scores are treated like a financial report card, but most people are judged by rules they were never taught. What you've been told about credit is often incomplete, misleading, or designed to keep you confused. In this video, we're exposing the truth about credit scores no one tells you, how they actually work behind the scenes, and what really moves your score up or down. Once you understand this, you stop fearing credit and start using it strategically. Before we dive in, if you want honest money knowledge that schools never taught, hit like, subscribe, and turn on notifications so you don't miss future breakdowns. Checking your own credit doesn't hurt your score. This is one of the biggest myths out there. When you check your own credit score, it's called a soft inquiry, and it has zero impact on your score. You can check it as many times as you want. What does hurt your score are hard inquiries, which happen when lenders check your credit for loan or credit card applications. But here's the thing, even hard inquiries only drop your score by a few points temporarily. The credit bureaus actually want you to monitor your own credit regularly. It helps you catch errors and fraud early. So stop avoiding checking your score because you think it'll go down. Get a free credit monitoring service and keep tabs on it monthly. Knowledge is power when it comes to your financial health. You have more than one credit score. Most people think they have one credit score, but that's completely wrong. You actually have dozens of credit scores. There are 3 major credit bureaus: Equifax, Experian, and TransUnion. Each one calculates your score differently based on the information they have about you. On top of that, there are different scoring models. FICO has multiple versions, and Vantage's score is another popular model. Your FICO score might be 720, while your Vantage's score is 690 for the exact same credit history. Lenders also use different versions depending on what you're applying for. Mortgage lenders often use older FICO models, while credit card companies might use newer versions. This is why you might see different scores on different apps or websites. They're all pulling from different bureaus or using different models. The key is to focus on the trends rather than obsessing over one specific number. Closing old credit cards can actually hurt you. This seems backwards, but closing old credit cards can damage your score in 2 ways. First, it reduces your available credit, which increases your credit utilization ratio. If you have $10,000 in total credit and you're using $2,000, that's 20% utilization. But if you close a card and now only have $7,000 in available credit while still using $2,000, your utilization jumps to about 29%. Higher utilization means a lower score. Second, closing old accounts reduces the average age of your credit history. Credit scoring models reward you for having older accounts because it shows your experience with credit. When you close your oldest card, you're essentially erasing years of positive history. Even if you're not using an old card, keep it open. Put a small recurring charge on it, like a streaming service, and set up autopay. This keeps the account active without you having to think about it. Your income doesn't directly affect your credit score. Here's a surprise. Credit bureaus don't actually know how much money you make. Your income isn't reported to them, and it's not part of the credit score calculation. You could be making $30,000 a year or $300,000 a year, and it wouldn't directly change your score. What matters is how you manage the credit you have, not how much you earn. However, income does affect your credit indirectly. Higher income usually means it's easier to pay bills on time and keep balances low. When you apply for credit, lenders will ask for your income, but that's for their own lending decision, not for your credit score. This is why someone with a modest income but excellent payment history can have a better credit score than a high earner who misses payments. Paying off collections doesn't remove them from your report. This is a harsh reality many people discover too late. When you pay off a collection account, it doesn't disappear from your credit report. It just changes status from unpaid to paid. The collection still stays on your report for 7 years from the date of the original delinquency. In fact, paying an old collection can sometimes hurt you in the short term because it updates the account activity, making it look more recent to some scoring models. Before you pay a collection, you should try to negotiate a pay-for-delete agreement. This means the collection agency agrees to remove the account from your credit report once you pay. Get this in writing before you send any money. Not all collectors will agree to this, but it's worth trying. If they won't do pay for delete, you might want to consult with a credit expert about whether paying it is worth it for your specific situation. Credit utilization updates throughout the month. Most people think credit utilization only matters on the due date, but that's not true. Credit card companies report your balance to the credit bureaus at different times, usually on your statement closing day. This means if you charge $5,000 on your card, but pay it off before the due date, the bureaus might still see that $5,000 balance if it was reported before you paid. To optimize your score, you want to keep your reported balance low. You can do this by paying down your balance before the statement closes, not just before the due date. Some people make multiple payments throughout the month to keep their utilization low. You can call your credit card company and ask when they report to the bureaus, then make sure your balance is low on that date. Authorized user status can boost your score fast. This is one of the fastest ways to build credit, especially if you're young or rebuilding. When someone adds you as an authorized user on their credit card, that account's entire history can appear on your credit report. If your parent or spouse has a card they've had for 10 years with perfect payment history, you get the benefit of that decade of positive history instantly. The primary cardholder's payment history, credit limit, and account age all help your score. You don't even need to have the physical card or use the account. Just being listed as an authorized user is enough. However, this works both ways. If the primary cardholder starts missing payments or maxing out the card, it'll hurt your score too. Late payments under 30 days might not be reported. Here's something that can save you if you slip up. Most creditors don't report late payments to the credit bureaus until you're 30 days past due. If you miss a payment but catch it within those 30 days, it likely won't show up on your credit report at all. You'll probably get hit with a late fee from your creditor, but your credit score will be safe. The real damage happens when you hit that 30-day mark. Then it gets reported and stays on your credit report for 7 years. Each additional milestone makes it worse. 60 days late, 90 days late, and so on. If you do miss a payment, pay it immediately and call your creditor. If you have a history of on-time payments, they might waive the late fee as a courtesy. Whatever you do, don't let it hit 30 days. Set up payment reminders, autopay, or whatever system works for you to avoid this. Your credit score isn't about being good or bad with money. It's about how well you play the system that measures risk. And like any system, it can be learned and used to your advantage. So let me ask you, what's one thing about credit scores that surprised you the most? Share it in the comments. Your question might help someone else too. If this video cleared up confusion around credit and gave you more control over your financial future, don't forget to like, subscribe, and share it with someone who still thinks credit is a mystery. Thanks for watching. I'll see you in the next one.